Okay, we are going to go ahead and get started. So today we are talking about taxes. As you know, you are filing your taxes in the upcoming months. So we are going to hear from Kris Kemp today. He is a member partner with ATA. He oversees the Owensboro, Kentucky office and is a great expert to hear from. So Kris, I will go ahead and hand it over to you.
Sounds good. Make sure everybody can hear me, which I think you can. I will be discussing mostly individual tax changes and items that will affect most of you, well, actually a lot of you, in preparing your taxes this year. Also, I will be addressing mostly some of the changes and things you can actually still do that can have an impact on your tax filing for this coming year. So what I will do is kind of walk through this presentation. So it's basically, let's talk about taxes. So we will skip ahead to our next slide or two. Like our next one says individual, and then we'll go to the next slide, which basically we will talk about the economic impact payments. Now, most of you had some experience with this from the prior year. So in the prior year, we had two payments. Now we had a lot of confusion with that because the second payment actually came for a lot of people in January of 2021. There was some confusion about when that was getting reported. That was supposed to be reported on the return last year. And basically what that is, it's not that you're taxed on it. It's that you have to do a reconciliation because even though you may have received the money, you may be able to get more money. Things like that. So that's why we had to do a reconciliation for the first two rounds. Well, in April of 21, I think it was March, April time period, round three came. Now, round three was a little bit different. Each round of income was just a little bit different from the first. So this one was basically $1,400 per person. And it even included dependents, which there was a line there in the previous ones where the dependents, some got the money, some didn't. And a lot of it had to do with whether or not they were over 16. But this one was basically $1,400 per person. Okay. Now there is going to be a letter that is sent out. They call it letter 6475, but basically it's from the IRS. So what you need to do this year is you're going to get 1 to 2 letters typically from the IRS this coming year. It's very, very important you get this letter or know the exact amount that you received. Okay. Noted at the bottom of this slide down here. All right. Now, the $1,400 was a little bit different than the prior year in who gets the money. There was a much bigger phase out on the previous two. This one was, I would call it a little bit tighter. You phased out of the money pretty quick. And as noted below, these are the phase out limits. Now, if you did not receive the money because your income was too high in 2020, doesn't mean you won't receive the money potentially in 2021 when you file your 21 tax return. It'll go through the same process. There will be a reconciliation. If your income was actually for the year below these limits, but it was above the limits in 2020, there's an opportunity to receive that money. Okay? So this is just something that you will get from the IRS. It's important to know. We had a lot of issues with it, especially at the beginning of the year, because what we would do as tax preparers is that we would ask, we would say, they sent letters, but they sent them in 2 different letters. We'd say, how much did you receive? We had numerous people say, oh, I didn't receive that amount, or I didn't get this check, I didn't get that check, when in reality they did. And the IRS does a reconciliation on their end also. So we had several notices, especially early in the year, people saying they did not receive the money when in actuality they did, or vice versa. So it's very, very important that your tax professional will require this moving forward. It's very important we get this information and get it right to avoid notices and to make sure you get the proper amount allocated to you. Okay, so that's the first item that you need to talk to your tax professional and make sure you have that information. Okay, so the next slide, the child tax credit. Now, the child tax credit has been expanded for 2021. We're going to give a breakdown on this between 2020 and 2021. And and some of the reasons why they did it and some of the advantages of it moving forward for you. So in 2020, which has been typical of most years, this child tax credit has been around for quite some time. It has gone up and down a little bit, but it's been in play for several years. The prior amount was basically $2,000, 16 and below. If you got kids like I do that kind of that have crossed that 16 stage and they start losing that child tax credit, it impacts you a little bit. And then now also that is partially refundable in the past, $1,400 per qualifying child. I'll get into what refundable means. And then you must have so much money. Yes, you have to have some earned income to qualify to get this credit. You just can't have no money and have kids. And then there's other credits for that. But this one was that you had to have a little bit of income to get that credit. So for 2021, there is a little bit of a change, and that change is it's going up, which is great. And it's gone up for 2 different age groups, which is, thank God for technology that helps us allow to do this information, to allocate it. But basically, it's gone from $2,000 to $3,000 per child. And the max age has gone up a year. So a lot of those people that were age 16 and you were getting ready to lose the credit, you get the credit for 1 more year as they are 17 now. And that the credit has gone up from $2,000 to $3,000, which is great. Also for you all that have young children, this is good also. So if your kid has not reached the age of 6 in 2021, if they were 5 and below the whole year, then you get an extra $600 for that kid. So it'll be $3,600. And it's also fully refundable. Now, fully refundable, and this will address another credit that we'll discuss here shortly, is that you probably don't pay much attention to the details of the return, but there are different timing of when your credits come into play. And it's not necessarily at the bottom as such as when you have money withheld from your W-2. That's at the bottom, and you're getting that money back. Well, some of these credits, as the child tax credit and earned income credit, and a few of those, well, they're a little bit higher on the schedule, meaning that if you don't have enough tax, it might just get wiped to 0, and then it moves down. Well, now you're going to get that money back now. So if you only had $1,000 of tax and you had $3,000 for a child tax credit, now you're going to get the full $2,000 back. Let's say 3,000 minus 1,000. So instead of only getting part of that back, being partially refundable, you're going to get it's going to be fully refundable. So you are going to see an increase there. Now, something to impact that, we'll go to the next slide. The advance payment of the child tax credit. So this is going to be fun, okay, this year for all preparers. In July, they started paying an advance credit for the child tax credit. Basically, in an effort, understand the reason. The reason was to help families go ahead and get this money quicker as opposed to waiting until year end. Now, couple of problems with this is, one is that they're going to send out a letter. I'll just kind of broach that, which is down there towards middle there in January of this year, letter 6419, which is going to give details of the amount that was paid to you. Okay. A couple of things happen here. Some people received the first couple of payments, then opted out. Some people may have 3 or 4 payments, opted out. Some may have opted out early, got nothing, which is great. Some that got paid a different amount on the first payment, and then the second payment was different, and then typically after the second payment, that was the same. So what you can't do is when you prepare your tax return, or if you're meeting with a CPA or whoever's preparing your return, is that you can't go to file it, which is what some people do, and they'll look at their December. Okay, well, how much did I get in December? How much did they pay me? Okay, well, I got those every time. More than likely, you didn't get that every time, because there's a lot of the one in July was a lot different than the one before. So what I will tell you is that if you can bring the letter 6419, that is gold. We want that. That's absolute. If you throw that away or you misplace it, which is probably going to happen to some of you, then we need to know the exact amount that each payment was, because it's the same deal. It's a credit that goes against. And so on the return, you may get 3,000 on that child, but if you received 1,500 of it already, then it nets against it. Maybe you got 2 payments of it and then opted out. Then we got to report the money you did receive that goes against the credit amount. So this is going to be, we've had some conversations internally. We expect some issues here. We'll do our best. As you're dealing with your preparer is going to be adamant about getting this information right. So this, along with the economic stimulus payment, are going to be musts that you report to your preparer, that you can get it right. Because if not, the IRS isn't just going to skip over it. They have tools in place that they will resolve these issues, and that they will do a reconciliation. And so in our mind, we assume you got the money, and that's the way we're going to treat it. Okay, is that we assume it. You need to prove to us exactly what you got. That way, worst case scenario, I'd rather them send you a little bit more money back than what we ran into before, with the client saying, no, I did not get that money. And then they were turning around and having to hold the IRS money because they failed to report the correct amount. So just keep that in mind. There are some safe harbors. If you can go to the next slide. And this is when they did the advanced credit. Okay, they instituted a safe harbor protection. What you'll find, and I'll show the example, is on the next slide, but basically there is a protection per child that they pay an advance amount. And some people, especially in, unfortunately, there's a lot of split custody cases, things like that. So you have children that are getting picked up on one return one year and another return next. So if we can go to the next slide, just an example here, that if, let's say, Jerry properly claimed child tax credit for 3 kids on his 2020 return, but only 1 child on his 2021 return. And that's because, like I said, we run into this a lot. There are a lot of cases of split custody and kids going from one return to the next, odd and even years. Not uncommon at all. This is where the problem comes in, and where we saw some economic stimulus issues also, is that the IRS will do it based upon the prior return. They don't know what's going to happen in 21. They can only look at what happened in 2020. So in doing that, let's say they paid on 3 kids. Well, if his AGI, say it's 46,000, files a head of household, he may get $4,000 in repayment protection, meaning that the IRS overpaid him a certain amount of money. However, he will be protected on up to $2,000 per kid in that instance. So just be aware that we know there are going to be some issues with this and getting this stuff lined out, but just be prepared to give that information to your CPA or whoever prepares your return, and just know that this is that we may run into these circumstances where a client received too much money, but at least there is some protections this time where that hasn't always been the case. So, all right, so let's go to the next slide. So that takes care of the child tax credit. All right, so now we're still with children there, which is great. So lots of changes here with the kids. This is the child independent care credit, and this has been around for a long time too. It's kind of been pretty stable in how it's done. And if your income's within a little bit lower number, it starts out at 35%. A lot of my clients, it basically caps at 20%, meaning that with your income, as your income increases, the amount that you're able to use as expenses and get a credit on those expenses reduces also, but it doesn't go below 20%. A majority of our clients who get this credit, that number is at 20%. Okay. Now the key here is total expenses used. So if I've got 2 children, the total expenses allowed in the past have been, the max I can use on one kid is $3,000. I might have $3,500 of expenses, of daycare expenses for that one child, but the max I was able to use was $3,000. And then let's say I was at the minimum percentage number, I could take $3,000 of my expenses, multiply it by 20%, I get a $600 credit. Okay, and so that's how you get the credit. If you have 2 or more, then you're capped at $6,000. It's been like that for a long time, to be honest. So if we can go to the next slide, we're going to talk a little bit about the changes for 2021. So now the percentage starts at 50%. So the percentage starts higher than 35 and then gradually reduces. The good part is it goes all the way until 125,000. So higher income people are going to get this that they haven't gotten past and haven't got a higher percentage, which is really good. Also, the total expenses used to calculate the credit are going from 3,000 to 8,000, and then your cap number at being 6,000 gets moved to 16 grand, which honestly in this area I see a lot of child care expenses for one child over $3,000. That's not uncommon. I don't see very many that are over $8,000 for one child, or more than 16 grand for two or more. So I think this amount getting moved this much, you won't be losing expenses and you'll be able to get a credit for it. So as noted below, the maximum available credit is $4,000 for one child, which would be 8,000 times the 50%, which is a lot more than typically what we would see. We may not see 4,000 for all of it, but again, that amount is going to be much greater than it has been in the past. So if you do have clients with child care expenses, which most of you do, then you will be able to get that family will be able to get a much higher tax credit, which is fantastic. Just something to be aware of when you're entering that information, to be aware of if they have the flexible spending account, dependent care items that they have pre-tax money that goes against that. You just have to watch that. I think it's usually box 10 on the W-2, so just be aware of that. All right, let's go to the next one. Okay, and like I said, this is another credit that's fully refundable. Typically, that's never been the case. This case has never been fully refundable. It's always been it's pretty high up on the credits, meaning that if you didn't have much tax liability or your tax liability was very little, you weren't getting this credit at all. Now it's fully refundable, which is we haven't seen before. So that's going to be great for young families. They're going to see. I think where people get a little nervous if they got the child tax credit and they got the advance payment, they were a little worried that their refund might not be as much, which would definitely be the case. However, the change with this child dependent care credit is actually going to increase that amount even more than probably what they're anticipating. Most people aren't even anticipating this at all. Hasn't been much talk about this, but this will help out a lot. So your eligible expenses, typical daycare, after school care, but then there are also, if you get into some spouse care that are physically or mentally incapable, along with the elderly parent that's living with you, there are some situations you'll be able to take this credit also. So just get with your CPA or your advisor to work through those to make sure you can qualify for that. All right, so we're getting close on time. We're about 20 minutes in, but I'm going to discuss a couple of little other items. So we'll go to the next slide. These are just some retirement options, and we're going to discuss just briefly just a couple of things to keep in mind. These are things you can still do. The year's already passed, but there are a couple of things you can do. Traditional IRA plan, very common. Typically, you can deduct up to $6,000 per person, $7,000 if you're older, if you're not covered by an employer-sponsored plan. If you do have an employer-sponsored plan, depending on your AGI, you still may be able to get a deductible IRA. We're all about maxing out retirement contributions if you can. Of course, not everybody can, but if you're in that situation, highly advisable. And this is the time you can still do it, all the way up to when filing. Let's go to the next slide. A Roth IRA, these contributions are not deductible. They're made with after-tax dollars. The best part, though, is obviously as that grows over time, you don't have to pay tax on it when you pull the money out. But there are certain income limits that you're limited. However, there is a backdoor way to do it. If you make too much money and you're not qualified you're not qualified under a plan at wherever you work at, you can do what's called a backdoor Roth, which is basically you contribute six grand to a traditional IRA and then convert it to a Roth immediately. And that's one way to do it. There are some rules with that. It's always best if you don't have a traditional IRA plan already in place because of some ordering rules, but give it to your advisor or CPA advisor or financial advisor if you feel like that might be a situation you could do. We'll touch on a couple other things here. The next slide is health savings accounts. Now, a lot of people are using these here in with the higher premium rates, and to reduce your premium rates, people have got their deductible a lot higher, and so they contribute to health savings accounts. Also, remember the employee contributions are deductible. The employer contributions aren't. So if your employer puts a little bit of money back for you, you can't deduct that on your return. Just know that. But it does go against what you're allowed to do in your contribution. So if your employer contributes a certain amount and then you contribute the rest, remember you still have maximum limits that you can put in there. It can be funded again until the due date of the return. Now, typically what most people do is they just, maybe if you're with a bank or something like that, you put your money in, but you really need to tell them, because if not, if I make a contribution to my HSA now, my bank or whoever is doing that deposit for me is going to put it for 2022. So you need to let them know it's still for a 2021 contribution. Make sure they know that. That way it gets recorded properly. Also note on here, I put on here April 18th, even though April 15th falls on a Friday. The last date to file taxes this year is April 18th, due to the fact of Emancipation Day being recognized in Washington, D.C. on April 15th, which is a federal holiday. So instead of being done on a Friday, your tax preparers get to work that extra weekend. We are excited, if you could not tell. Okay, so let's go to the next slide. Flexible spending accounts. Just so you know here that this has changed. Also, it's kind of pre-tax dollars. The past couple of years, we're able to roll that over. For 20 and 21, you typically were not eligible to roll those over. You had to use it or lose it. However, 2020 rolled to 21, 21 rolled to 22, but that's just temporary. As of now, it just goes back to normal rules. So if you have flexible spending account and you got some money in there, use it quickly. Use it as soon as you could. That way we don't have any carryovers moving to the following year. I think the last slide is the next one, and we'll just touch on real briefly. Required minimum distributions are back for 21. They were waived in 2020. I had several clients who did do that, who waived it, but they did have to take one in 2021. The earned income credit is expanded. It has always been, I think it was age 24 that you had to be, if I remember correctly, before you got that. Now, if you file on your own, you're not in college or school at 19, now you're eligible for that earned income credit. So that has been expanded. Plus, there's some rules with that if your 2020 is not as much as maybe your 2021 is not as much income, it's not as much as your 2019, you actually have some flexibility to play with those years to get a higher credit. So that's something that needs to be, if you go to a different preparer, if you go to the same preparer for several years, that will come into play, that the system, your tax software should do a lot of that for you. If you go to somewhere new and you typically qualified for an earned income credit, that is something to be aware of, that you may have to look back to the 2019 income to figure out which one works best for the client. Unemployment is taxable for 2021. It was not for 2020. Student loan forgiveness is not taxable for 21, and the premium tax credits, repayment is back, although it's still at a pretty good rate. And what that is if you got a premium tax credit for getting health insurance on the marketplace, there was typically, you got a premium tax credit in play in there. The rule was if you made too much money though than what you forecasted, you may have to pay some of that back. It got waived in 20. It is back for 21, but again, it's not as bad. They've lowered the way they do the calculation. And I'm not going through the calculation because, one, it would be really difficult, and two, y'all would leave immediately. We don't want to do that. So even though we've come to the conclusion of our presentation for today. So the next slide, basically, it just says questions. So I think I've hit my limit, 25 minutes. I went just a little bit over, but I think we're open to some questions if there's any out there.
Thank you, Kris, for that interesting topic. I know it's on everybody's minds right now. So if you don't have a question at the moment, you can always email Kris and I will drop that in the chat. But you can also drop a question in the chat for the next couple of minutes. This is recorded, so we will have that on our YouTube channel, and everybody that's registered for this event will receive a copy of this presentation to review back on. There was a comment in the chat. I don't know if you want to go back and address it, but it mentioned on the checks for children. We do have another question. If someone opted out of the child tax credit, do they need to let their tax person know, or will they receive something to show they opted out?
I don't think they'll receive anything that shows they opted out. You still need to let your tax preparer know that you did opt out and that you didn't receive any money, because a lot of people opted out after the fact, after they got a payment or two. So you still need to let them know one way or the other. And that's going to be a question everyone asks. Every preparer should ask that question no matter what. So you need to be prepared to answer that for the preparer.
Okay. And then another question is, as a firm, are we to assume they did in fact receive all stimulus payments and advanced child tax credits unless they can prove they opted out?
I think that's probably internal. I would say I
so
always assume yes, that they did receive it. Of course, if we look at last year's tax return, we should be able to decipher whether or not they received that amount of money. But like I said, I'm always under the assumption they did get the money unless they tell me otherwise, because I would rather the client get an additional refund, if anything, than for what we ran into before, which was the client gets a notice and the client has to pay. So.
Okay. Well, I believe that is all of the questions for now. I'm going to drop your email in the chat. We do have one more question. And it says, any reporting changes for required minimum withdrawals?
I don't think there's any reportable. I don't think there's any changes on that. There were some changes on required minimum distributions, changing of the age. It went from 70.5 to 72, but I don't think there's any differences other than obviously it's back. So.
Okay. All right. Well, I believe that is all of the questions at the moment. So I have just dropped Kris's email in the chat. It's kkemp@atacpa.net. So any questions at all, please reach out to him or your tax professional in whatever office that you're in or location that you're at. And like I said, you will be receiving this presentation as well. Thank you so much for joining us for ATA Business Insights. These are just short snippets on different topics that we think would be useful for different clients. And our next one will be at the end of April. So please watch our social media and email channel for that information. Okay, thank you so much, Kris.